we're continuing to see inflation coming through in things like you mentioned, in food, in energy. Even if you're looking at nat gas in the United States, you're looking at all of the supply chain issues, not just in China, but also on the rail networks in the United States. So how long can these companies maintain that pricing power if the consumer can't pony up the cash?
Well, on energy, there's two big inflationary pain points, and we're going into a midterm election the back end of this year. And what destroys presidencies and gets a huge shift in the House is inflation. So Biden knows that, and all of a sudden you start to see him change terms on policy regarding fracking and drilling and federal land on oil, opening up the spigots there to try and get energy prices down. At the same time, half of the food problems are supply chain based. That's the challenge. It's not the actual fact that these prices will remain this high forever. We've got to get the skids moving on just getting trucking back in the US, and those price points are starting to come down. There's a lot of problems on supply chain still, and those are transitory issues. Now, if you're president in the midterms, you really, really, really want to find a way to hold some seats, and the way to do that is get pricing down on food, pricing down on energy. So I'm going to make the assumption that he's a savvy politician, and all of a sudden you're going to see a lot of focus on those two elements in the next few months. And I think by doing that, it'll be self-correcting to a certain extent. My whole point is getting back to what the Fed does. And I think what the Fed signals today was 2 more 50 basis point hikes, and that's why the market rallied. I think it can absorb that. That's still very accommodative. It's still very accommodative at historic rates, and I think that's really what you've got to decide. Are you a bull? Are you a bear? I'm more on the bullish side.
Hi, Kevin. How can we be in a cycle of growth if we saw a negative GDP print? And staying with the data, payrolls this week, what's it going to tell us about where we are in the cycle?
I really warn everybody when you look at a single print not to. It's not enough. You need a data set of 5 to 6 before you see a trend emerging. All that's happened in the last 90 days has been this concern about the Fed raising rates. They had to do it at some point. They're doing it now. And also, what are they going to do about mortgage backs? Those are long duration, 10-year plus, another concern. But it's not straight up on rate hikes. There's too many other concerns out in the market that are going to hold Powell back. We've talked about the Russian invasion. We've talked about the concern of Russian oil coming off the market and all the other issues around instability in China. All of that, the lockdowns in China, these are real concerns. That holds the Fed back in my book. And as a result, you get more of a accommodative Fed in the back end of the year. And frankly, all of those issues don't directly impact S&P earnings. The war in Ukraine is a tragedy, but it doesn't really affect S&P earnings. Maybe it's 1.5% at best. So I'm sorry, I just can't get that bearish.